Reading corporate earnings call transcripts in 2026 usually feels, I don't know, like watching a really slow game of chess where both players are just terrified of making a mistake.
Yeah, exactly. It's usually super defensive.
Right. You have CEOs aggressively guarding their margins and CFOs constantly blaming macroeconomic headwinds for any missed targets. Plus, the endless safe harbor statements.
Oh, the safe harbor statements are the worst part.
They really are.
Yeah.
But welcome to the deep dive, everyone. Today, our mission is unpacking Airbnb's Q2 2026 earnings call transcript, and it reads completely differently from the rest of the market.
It really does. It honestly doesn't read like a mature S&P 500 company trying to squeeze just a few extra basis points out of a saturated market.
All right. We're going to translate all that Wall Street jargon into plain language for you. We'll structure this around the headline numbers, the story driving those numbers, management's future guidance, and then give you a clear bottom line.
Because if you're holding the stock, or even just considering it, you need to understand what's actually happening here. It reads like a hyper-aggressive, AI-native startup that somehow already has billions of dollars in free cash flow.
Which is wild, and that's the hook here, right? Because while so many companies are out there just talking about AI in their investor presentations, hoping to catch a valuation bump.
Yeah, just throwing the buzzword around.
Exactly. Airbnb is actually showing massive bottom-line financial results from rewiring their entire company around it.
The contrast with the rest of the tech sector right now is just stark. We've spent years watching theoretical promises. But this Q2 report is the actual realization of those promises.
It's like if you think about reading an earnings call transcript as looking under the hood of a car, most of the time we're just admiring the shiny paint. But today we're looking directly at the engine's horsepower.
I like that analogy. And to understand how fast that car is moving, we first need to look at the dashboard, which means the headline numbers.
Right. Let's get into the dashboard. And the headline numbers here are a massive story of growth. Revenue grew 17% year over year to $3.6 billion.
Which, by the way, exceeded the high end of their own internal outlook.
Yeah, beating your own high-end guidance is a huge flex. And then you look at gross booking value, or GBV.
And just to translate that real quick for anyone new, GBV is literally just the total dollar amount that guests actually paid on the platform. It's the whole pie.
Exactly. So that GBV grew 16% year over year to $27.2 billion.
It's a staggering amount of money flowing through the platform in a single quarter. And seeing those two metrics, revenue and GBV, growing in tandem at 16 and 17%, that indicates a highly optimized marketplace.
Right. They're not just taking a bigger slice of a shrinking pie. The pie itself is getting much bigger. Nights and seats booked grew 10%.
Which is an acceleration from Q1, actually.
Yeah, that acceleration is key. But let's talk about profitability, because the bottom line is where it gets crazy. Net income hit $816 million, and adjusted EBITDA reached $1.3 billion.
And for anyone who gets lost in the acronyms, adjusted EBITDA basically just means their core operating profit. It's the cash engine of the business before the accountants get in there with taxes and depreciation.
Right. And that $1.3 billion represents a 35% margin.
Which is elite territory. Dropping $35 of every $100 in revenue straight down to operating profit for a consumer marketplace at this scale, it's almost unheard of.
And it meant their free cash flow was a massive $1.3 billion for Q2 alone, which allowed them to do what? They immediately turned around and did $1.1 billion in stock repurchases.
Yeah, they bought back their own stock aggressively, which sends a huge signal to the market. It means management believes Wall Street is totally undervaluing their future cash flows.
But wait, I have to push back here a little bit. Isn't Airbnb already a super mature company? How are they suddenly accelerating growth, especially in what is objectively a pretty tough global economy right now?
It's a great question, because the data shows this growth isn't just returning users taking their annual summer trip. Growth among first-time bookers actually accelerated to 11%.
It's 11% for first-time users.
Yeah, and Brian Chesky, the CEO, specifically noted that's the highest growth rate they've seen in that cohort in 4 years.
Wow.
Right. And Gen Z is the fastest growing segment among those new users. Plus, people aren't just using desktop browsers anymore. App bookings are up 23%.
Which means the app now accounts for, 64% of total nights booked?
Exactly. Capturing Gen Z on mobile is a massive lifetime value play. If a 22-year-old forms the habit of defaulting to the Airbnb app instead of a hotel aggregator, that compound value over the next 30 years is immense.
But you'd think, okay, maybe this is just a macroeconomic tailwind, like maybe a delayed post-pandemic travel boom in some specific region.
That's what a lot of analysts assumed. But the CFO, Ellie Mertz, completely dismantled that theory on the call. She pointed out that this acceleration is happening everywhere at once. You have high single-digit growth in mature core markets like the US, France, the UK, and Australia.
Right.
But then you look at emerging markets. Latin America is growing at roughly 20%. Asia Pacific is in the high teens. India and Brazil are growing twice as fast as the baseline.
So it's not a localized boom at all.
No, not at all. When you see simultaneous acceleration in both ultra-mature and highly emerging markets, that tells you it's a structural improvement to the product itself.
Right. It's not just the wind at their backs. The boat is literally getting faster.
Exactly. The platform is just getting better at convincing a casual browser to actually put in their credit card information.
Which perfectly transitions us to the next part of this deep dive. The numbers are incredibly strong, but numbers are just the result of actions. So let's look at the story behind the numbers and how they actually achieved this.
And this is where the AI narrative really shifts from theoretical to highly practical.
Yeah, because when analysts pressed Chesky on how a massive company reaccelerates like this, he straight up said there's no single silver bullet product.
Right. It's not one shiny new feature.
It's the compounding effect of them basically rebuilding Airbnb as an AI native company.
And the operational metrics he shared to prove that are probably the most important data points in the whole transcript. He said the time from concept to product launch dropped by 60%.
60%. That's cutting development time in half and then some.
Yeah, and because of that, the sheer volume of features they shipped increased by nearly 80% compared to the same window last year.
I mean, if you think about it like a factory, imagine a massive auto plant that suddenly upgrades its assembly line with next-gen robotics. Overnight, they're churning out 80% more cars in 60% less time.
And crucially, they're doing it without needing to hire a massive new workforce. The AI is functioning as the robotics layer for their software engineering teams.
So if you're an investor listening to this, what that means is massive operational leverage. They can grow revenue without proportionately growing headcount.
Exactly. The fixed costs stay flat, but the output skyrockets. But the AI isn't just on the back end helping coders, it's aggressively touching the customer interface too.
Right, let's talk about the customer support data. Their AI assistant is now handling support routing in over 50 languages.
And the crazy stat here is that nearly 45% of issues that start with the AI are resolved entirely without a human agent.
Almost half of Tier 1 support is just automated away. That led directly to a 16% year-over-year decline in customer support costs per booking.
Which is huge for margin expansion.
Yeah.
But there was this really fascinating exchange during the Q&A about the cost of running these AI models.
Oh, the inference costs.
Right, inference costs. Because for a lot of consumer tech companies like social media or ad-supported sites, running generative AI is incredibly expensive. It kills their margins.
Yeah, if a platform makes 2 cents when you click an ad, but the AI chatbot costs 4 cents in computing power to generate an answer, the whole business model breaks down.
Exactly. The server cost eats the entire transaction value.
Yeah.
But Chesky pointed out that Airbnb is entirely different because their transaction value is so massive.
Because people are booking multi-$100 vacations.
Right. If the take rate on a $1,500 booking gives you a couple $100 in gross margin, who cares if the AI compute cost a few pennies?
It's basically a statistical rounding error at that point.
Precisely. If that AI interaction saves a $15 human customer service ticket or stops a user from abandoning their cart, the return on investment is just astronomical.
So they have this massive structural advantage. They can deploy the most sophisticated, heavy AI models across their user base without tanking their operating margins.
Which legacy competitors with lower transaction values or thinner margins just cannot afford to do at scale.
Okay, so the AI is making them faster and cheaper behind the scenes. But what does all this actually look like for you, the guest, trying to book a weekend getaway? Let's dive in part 2 of the story. Removing friction.
Yeah, and management called this internal initiative Project Hawaii. It's basically a study in how micro-optimizations drive macro-level revenue.
They started with something as basic as the login screen, right?
Yeah, Chesky noted they completely revamped the sign-up and login architecture because they realized hundreds of thousands of users were failing to log in every day.
That's insane. Hundreds of thousands of people trying to give you money, and they literally can't get through the front door.
It's pure revenue bleed. Fixing that one leak at the top of the funnel probably paid for the entire Project Hawaii initiative.
But they went way deeper than just password resets. They rolled out AI-generated listing highlights, so instead of reading a host's giant wall of text, you get neat little bullet points.
And AI review highlights, too. It extracts the consensus on things like cleanliness or Wi-Fi speed from hundreds of messy reviews.
But the absolute biggest game changer on the guest side, the thing driving massive revenue, is Reserve Now, Pay Later, or RNPL.
RNPL is fundamentally reshaping their unit economics. The CFO revealed it now accounts for over 20% of total gross booking value.
A fifth of a $27 billion marketplace is using deferred payments. That is a massive shift in consumer behavior.
It really is. And management said RNPL is doing two things. It's driving much longer lead times, meaning people are booking further out, and it increased the average daily rate, or ADR, by 5% year over year.
Let's unpack the psychology of that for a second. In an economy where people are feeling the pinch of inflation, why does an installment plan actually make them spend 5% more per night?
Because it completely diffuses the pain of paying. When you have to put a $3,000 charge on your credit card today for a trip in 6 months, you feel that financial hit immediately.
Right, you get sticker shock.
Exactly. And that makes you price sensitive. You compromise. You book the place 3 blocks from the beach instead of right on the water just to save $500 today.
Because your budget right now is dictating your experience in the future.
But RNPL decouples the booking from the immediate financial burden. You feel wealthier in the moment because your immediate bank account isn't drained.
So you look at the beachfront property and think, well, it's only an extra $50 a month on the installment plan.
Yes, you justify the upgrade. And that behavioral shift is exactly what's pushing that ADR up by 5%.
And the longer lead times give them a massive strategic edge over hotels, too. If Airbnb locks you in for a trip 8 months from now because you could defer the payment, traditional hotel chains don't even get a chance to compete for your business.
They're capturing calendar share way before anyone else even enters the chat.
So that's the guest side. But Airbnb is a two-sided marketplace. What are they doing on the host side? Because there was a lot of talk about the single service fee migration.
Yeah, this is where the platform dynamics get a little ruthless. Historically, hosts could choose how the Airbnb fee was shown. A lot of them hid it, passing it on to the guest as a separate line item at checkout.
The dreaded cleaning fee and service fee sticker shock. Everyone hates that.
Exactly. It killed their brand reputation for a while. So the new structure forces a single service fee. The entire platform cut is deducted straight from the host payout.
But why does Airbnb actually care how the host pays the fee? As long as Airbnb gets their 15%, who cares if it's upfront or at checkout?
It's all about search page optics. If hosts bury the fee, their base nightly rate looks lower on the search results. But when guests get to checkout and see the real price, they abandon the cart.
Right, and it makes Airbnb look bad when someone is cross-shopping on Google Hotels or Expedia.
Exactly. So by forcing the single fee, hosts have to roll that cost into their baseline nightly rate. But here's the catch. They're competing on a page with dozens of other properties.
So if they just raise their price to cover the fee, they look too expensive and lose their search ranking.
Right. It forces them into a game theory dilemma. Hosts basically have to swallow a bit of margin compression and lower their effective rate just to stay competitive.
Wow. So Airbnb is using its marketplace power to force hosts to price more efficiently. It suppresses overall prices, making Airbnb look cheaper compared to hotels, which drives overall volume way up.
The platform wins on aggregate volume, even if the individual host feels a little bit of a squeeze.
That's incredibly savvy. And to help hosts deal with that, management talked about a massive incoming AI pricing model, right?
Yeah, they framed this as a potential growth lever even bigger than RNPL. Most retail hosts have no idea how to do algorithmic yield management.
They just guess a price and leave it there.
Right, so they leave money on the table during demand spikes, and their calendars sit empty during slow seasons.
But the AI pricing tool changes that. It's going to ingest data like local hotel prices, airline volumes, event schedules, and dynamically adjust the host's rate.
If a Taylor Swift concert is announced in your city, the AI instantly raises your rate to capture that premium. If it's a slow Tuesday in November, it drops it just enough to secure a booking.
It's giving enterprise-level revenue management to someone renting out their spare bedroom. It just maximizes the total yield of the whole platform.
It's a game changer. But, making homes cheaper and easier to book is only part of the story.
Right, which brings us to part 3 of the story behind the numbers. Because Airbnb isn't just optimizing homes anymore, they are actively expanding their inventory into enemy territory. Hotels.
This is the Trojan horse strategy, and it is brilliant. Chesky said the initiative to get independent and boutique hotels onto the platform is going significantly better than expected.
Hotel nights booked are growing 3 times faster than their core homes business. It's still a single-digit percentage of total nights, but the growth curve is vertical.
Hotels want to be on Airbnb because the platform has a massive, young, mobile-first, US-heavy audience that traditional hotel loyalty programs literally cannot reach.
Plus, Airbnb's take rate is usually better than the crazy commissions Expedia or Booking.com charge them. But the hotel revenue itself isn't even the real play here, is it?
No, not at all. Chesky dropped this killer stat on the call. Roughly 35% of first-time hotel guests on Airbnb subsequently return to the platform to book a homestay.
Wait, 35%?
Yes, over a third of them.
That is insane. Customer acquisition cost, or CAC, is usually the biggest expense for travel companies. They spend billions on Google Ads just to get one booking.
And Chesky explained this using the jewelry district concept. He compared it to Amazon back in the day when they expanded from just books to selling CDs and DVDs.
Oh, right. Because critics back then said, why sell CDs? It's going to cannibalize your book sale.
Exactly. But Amazon realized that a guy coming to buy a CD was highly likely to throw a book in his cart, too. The new product didn't cannibalize the core business. It acted as a lead generator.
So for Airbnb, there's a huge group of business travelers or older folks who just prefer hotels and refuse to use the Airbnb app. By putting hotels on the app, Airbnb gives them a reason to finally download it.
They come for the hotel, they experience how easy the checkout is with RNPL, they interact with the AI support, and boom, they're in the ecosystem.
The hotel is effectively paying Airbnb a commission to hand over a customer. And then Airbnb converts them into a highly profitable home renter for their next family vacation.
It's a zero-cost, self-funding customer acquisition loop. They're literally using the hotel industry's own inventory to steal their future lifetime value.
Okay, but I have to push back here.
Yeah.
Because it's not just hotels. They're adding new services, too. Car rentals, airport pickups, which they built in 6 weeks, by the way, resort passes, even luggage storage.
Yeah, the luggage storage was mentioned as a total sleeper hit.
But isn't there a massive risk of losing their brand identity? I mean, phase 1 was homes. Phase 2 is this one-stop travel shop. Phase 3 is everyday living. If they offer flights, hotels, cars, and groceries, don't they just become another generic low-margin Expedia?
That is the exact risk investors worry about. But the defense against becoming a generic OTA lies entirely in how they are executing this. It's all about partnerships.
Okay, explain that.
If Airbnb tried to vertically integrate, like buying fleets of rental cars or building grocery warehouses, they'd take on massive capital expenditures. You would destroy their free cash flow.
Right, they'd become WeWork, just bleeding cash on physical assets.
Exactly. But they are strictly using a partnership model. Airbnb acts purely as a lead generation and routing layer. They integrate third-party rental car agencies into the back end of their app.
Ah, so they incur zero capital cost for the physical cars or the drivers.
None. They just use their massive audience, route the demand to the partner, and take a high-margin commission. They're expanding their total addressable market, the TAM, while keeping their costs strictly limited to software development.
It's super capital light. They own the customer relationship and the user interface while renting the physical fulfillment.
Exactly. Which is why their margins aren't collapsing despite all this expansion.
Which is the perfect transition to Section 5, management guidance. Because all this innovation is painting a rosy picture. But as retail investors, we need to know what management is actually promising for the future.
Right. And for Q3, they're expecting revenue between $4.69 and $4.77 billion. That's 15 to 17% growth year over year.
But the big news was that they raised their full year 2026 outlook for both revenue and adjusted EBITDA.
Yeah, they explicitly said the full year EBITDA margin is expected to be at least 35.5%, up from their previous guidance of 35%.
Which, raising full year guidance in a Q2 call is a massive flex. It tells Wall Street that the AI efficiencies and the RNPL boosts aren't just one-off anomalies. The compounding effects are permanently elevating the company's efficiency.
And it shows resilience, too. The CFO is essentially an accounting illusion. There are two things suppressing it. First, the reserve now, pay later volume.
How does that affect the math?
When you book a trip 9 months from now using RNPL, the total gross booking value is recorded today. That inflates the denominator. But under accounting rules, Airbnb can't recognize all that revenue until you actually make your installment payments closer to the trip.
Oh, I see. So the demand metric skyrockets today, but the revenue recognition is deferred. So the ratio looks mathematically flat right now.
Exactly. It's a timing issue, not a lack of pricing power. And the second factor is the new verticals. When you launch a new service, like airport pickups, you usually offer heavy incentives or lower take rates to the vendors to build supply quickly.
Right. You subsidize it to get people used to using it.
The CFO made it very clear. If you strip out the deferred revenue from RNPL and the temporary promos for new business lines, the core take rate is actively expanding.
Okay, that makes sense. But let me ask you this. If they are investing heavily in AI compute costs and subsidizing new verticals and still raising their profit margin to 35.5%, what happens when these investments mature? What's the ceiling here?
An analyst asked basically that exact question, and the CFO's answer was incredibly bullish. She pointed out that over the trailing 12 months, they generated $4.8 billion in free cash flow. That's a 37% free cash flow margin.
Wow.
And she framed that mid-30s margin not as a ceiling, but as a relative floor of profitability going forward.
Wait, a floor?
Yeah. Because the AI architecture has so completely decoupled their revenue from human labor costs, they can just continuously plow cash back into experimental growth without ever letting their core margin drop below that 35% mark.
So if they ever just stopped expanding and decided to harvest the cash, the margin could theoretically push into the mid-40s.
Easily.
Yeah.
But they're choosing to use that cash engine to conquer the broader travel market instead.
Which brings us to section 6, the bottom line. Let's synthesize all this into actionable insights for the listener.
Based on the factual data in this call, the verdict is clearly overwhelmingly bullish. To build a bear case right now, you basically have to assume a catastrophic global economic collapse because internally the company is operating flawlessly.
Let's break that bullish stance down into 3 key arguments. Number 1, speed of execution. AI is not a chatbot gimmick here. It literally cut their development time by 60%.
The fact that they spun up an airport pickup service in 6 weeks is terrifying for legacy travel companies. They can iterate faster than competitors can even schedule a meeting to discuss the threat.
Argument number 2, a strategic masterclass in supply. Using hotels as a zero-cost customer acquisition tool is brilliant.
That 35% conversion rate from hotel guest to home renter solves the biggest problem in travel, which is customer acquisition cost. They're expanding their demographic without burning cash on Google Ads.
And argument number 3, financial discipline. They are expanding margins to 35.5% while absorbing AI compute costs and launching new verticals. It proves highly efficient capital management.
They generate so much cash, they just casually bought back over $1 billion in stock in a single quarter.
So the actionable takeaway for you, if you hold the stock or are looking at it, the narrative is shifting. This isn't just a mature tech company squeezing out efficiencies anymore. It is a reinvigorated AI-native company expanding into a total travel ecosystem.
Yeah, they are transitioning from dominating alternative accommodations to becoming the definitive operating system for global travel.
And doing it with a level of profitability we almost never see. Which brings us to the outro, and I want to leave you with a provocative final thought. Because Chesky mentioned something at the very end of the call about the death of the search box.
Oh yeah, transitioning to a conversational trip planner.
Right. Think about how archaic it is to type a city and 2 rigid dates into a web form. He envisions an interface where you just speak in natural language. You say, plan an anniversary getaway next month, somewhere warm, under $5,000.
And the AI just orchestrates the whole thing. It books the flights, gets a boutique hotel for 2 nights, a private villa for the weekend, reps the rental car, and has groceries waiting in the fridge.
Exactly. So here's the thought to mull over. What happens to the global hospitality industry when Airbnb transitions from just an app where you rent a bed to an omniscient AI travel agent?
An agent that knows your preferences so well, it actively curates your reality the second you get off a plane.
It's a massive, audacious vision, and based on these numbers, they actually have the cash and the architecture to build it.
They really do.
Well, thank you for joining us on this deep dive. We hope this helped translate the corporate jargon and showed you the engine driving those headline numbers. Keep questioning the consensus, keep looking beneath the surface, and we'll see you on the next deep dive.